Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month lead and tin.
LME 3-month lead. 9 weeks ago, I said we had a choice of patterns here, and I quote, "We have a possible choice of pattern here, or maybe even both patterns acting at the same time." Anyway, the first pattern is a possible mid-November 2022 to date head and shoulders top. This pattern is a little extended right now, and it has not as yet seen a significant break below the neckline. That's actually currently at 1983, which is highlighted in green on my daily chart. The second pattern is a derivation and extension from this head and shoulders top. It utilizes a neckline as the lower trend line plus an optimized upper trend line, currently 1961, and highlighted in bright red to together make a possible descending wedge pattern. End of quote. I also added, and I quote, "Right away, the optimization I've undertaken makes me suspicious about the veracity of this possible pattern, but I'd rather say it and only look a fool now than have it confirmed later on." The market exited out of this optimized descending wedge pattern back in mid-March on the upside and proceeded then to do nothing. We've not had the moves for a descending wedge pattern, nor for a continuation head and shoulders pattern. What we have seen is more or less sideways movement, with prices capped by layered resistances and held up by layered supports. On the top side, we have had resistance from the now declining medium moving average, currently 21.28, and I suppose in part at least eroded by the 50% Fibonacci line of the March 2020 to March 22 move at 21.35, plus a mainly buy as well the surprising resistance of the lower trend line extension of the May to June 2021 descending triangle, which I have highlighted in purple on my daily chart. That's been a complete surprise to me. Likewise below, we have layered support starting at 2058, then 2039, which is the January 2020 high, 2021 and 2001. This last one especially is interesting. This is all before even touching the trend line of the now broken descending wedge pattern. So where has that left us all now? Well, that's very much an open question, as the moving averages are getting awfully close together and nothing much is showing much of an indication of direction right now. Finally, it's worth still noting that still overshadowing all of this was January's monthly key reversal down. LME 3-month tin. As I've previously mentioned countless times, we have a series of stratified resistances and support levels that slow but do not halt the market's major moves. The significant ones were, and they still are, at the following levels: between 23,000 to 24,155, at 21,360, between 24,35 and 25,10. Slightly lesser support resistance levels are at the 2013 high at 25,250, the 2012 high at 25,875, the lesser Fibonacci line at 27,330, the July 2011 high at 29,010, the lesser Fibonacci line at 30,205, and finally a major one, the interesting 50% Fibonacci line of the March 2020 to March 2022 move at 31,845. To all these, I've previously added the 50% Fibonacci line of the recent late October 2022 to late January 2023 move at 25,020. So, looking at a bigger picture, I said some 15 weeks ago that the 50% Fibonacci line at 31,845 would be the real test of any rally, and so it proved, as prices did not break up over this 50% Fibonacci line, but just breached it with one single close over before heading back down, gapping lower indeed. On its way lower, the market hesitated in February, making a small bearish halfway hesitation, before fulfilling the pattern down at the 21,360 support. Since then, we've gradually moved back up, through congestion and resistances, but peaking short of the middle time, currently at 29,825, of the mid-April in the mid-April of the newly drawn and highlighted in dark blue on my daily chart, late October 2022, mid-March 2023 bullish shift pitch hawk. Now overall, the market has moved a little higher in between the middle time overhead and the lower time below. Lower time is currently at 23,500 of this bullish shift pitch hawk, but it has not really tested either, which after 2.5 months I'm a little suspicious of. This, plus the general shape of the action, has prompted me to ask a simple question. Is the action since the height of January a possible, very large bearish halfway hesitation in the making? It is too early to say for sure, but we do have a lot of congestion support below the market, the nearest being the flatlining long moving average, currently at 23,930. Hence, for this reason, I've decided to draw both a bearish Andrews and shift pitch hawk for the 2023 action. The reason for both is that neither looks that great right now. The bearish Andrews has had the upper time breached, currently at 24,550, but at the same time, this upper time has provided a good idea of the bearish angle of attack of the market since mid-April. Whilst the bearish shift pitch hawk has the market comfortably moving lower between the upper time above, currently at 26,590, and the middle time below, currently at 22,440. Again, not wrong, but not touching either time here as well. Leads me a little bit suspicious. I have drawn them both here because right now I cannot decide which one works best, if at all. And this is the reason I have not highlighted them as well. It all depends on whether the lower time, highlighted in dark blue, of that larger 2023 bullish shift pitch hawk still holds or doesn't.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.